Hi, my name is Tommy Jones, and we've all felt the impact of the coronavirus, what it's done to our family, what it's done to our regular way of life, and what it's also done to the financial services industry. And I wanted to make this video today and dispel some myths about the mortgage industry and how mortgages really work, and why you're hearing all these rumors and some truths about some mortgage companies closing, some of the products that we were able to offer our clients just a month ago no longer exist. So today I wanted to take that time and debunk and also inform the general public and our industry. The current corona crisis is having a crucial impact on our mortgage industry as we know it. See, this pandemic could make the 2008 financial crisis pale in comparison. See, the pressing issue centers around capital. And as we know it, that is what's required to fund and close loans for mortgage lenders. And without money, we cannot function. So I've received several calls and emails over the last few days about interest rates, discount points, programs that were once in place less than 30 days ago that now no longer exist. So I wanted to take this time to explain what is happening and how the mortgage market really works. So let's begin with the regular mortgage process. So when a buyer goes to a mortgage originator to obtain a mortgage, once the loan is closed, it's handled by what's called a servicer. So what happens is that the servicer is where you send your payments to. The borrower submits a payment. However, what most people don't know is that the servicer doesn't actually own the loan. They are simply have the function of maintaining the loan, which means they collect the payments, they forward them to the investor, they pay your taxes, they pay your insurance, and they answer questions. However, while they maintain the service of the loan, the asset itself is sold to a government agency like a Fannie Mae, a Freddie Mac, or a Ginnie Mae, and the loan then gets placed outside in a large bundle. Now, when this happens, it sometimes ends up in the hands of an investment banker, and that banker converts those loans into what's called MBSs, or mortgage-backed securities, which can be sold to the public. Now, this shows up in different investment instruments such as your mutual funds, your insurance plans, and even your retirement accounts. Now, the servicer's role is extremely critical, and in order for a servicer to retain the rights to a loan, what a servicer would typically do is pay on average about 1% of the loan amount up front to the mortgage company. Now, the servicer then receives the monthly payment that is equal to about 30 basis points per year. So as you can imagine, when interest rates drop dramatically, there is an increased incentive for many people to refinance their loans more rapidly. This causes the loan that the servicer has on her books to pay off sooner, often than the 3-year break-even point. So when this happens, it creates what's called a runoff, which creates losses to the mortgage lender who is servicing the loan. The more loans the mortgage lender's portfolio loses, the greater the loss or the profitability of that portfolio. But at the same time, lenders typically experience an increase in new loan activity because of the decline in interest rates. Now, this gives them additional income to help overcome the losses in their servicing portfolio. But this coronavirus has done something that we have never seen. It has not only virtually shut down the U.S. economy, but it has shut down the world economy, which has created an unprecedented amount of job losses. Now, this adds a new type of risk to the servicer, although the servicer does not own the asset, but they have the responsibility to make the payment to the investor even if they haven't received the payment from the borrower. We've seen the news where the government has come in and cut the rate to borrow money down to zero. Well, that's not necessarily true in the mortgage industry, because when the government's efforts to help those who have lost their jobs because of the corona shutdown, they have granted a forbearance for mortgage payments for effective individuals. Now, this presents an enormous obstacle for servicers who are obligated to forward the mortgage payment to the investor. But what has not yet been contemplated is the fact that a borrower who does not make their very first mortgage payment causes the loan to be ineligible to be sold to an investor. Now, what this means is that the servicer must hold onto the asset itself, which also ties up its line of credit. And with so many new loans being originated of late, the amount of transactions that will not qualify for sale will be staggering. This restricts the lender's ability to clear their pipeline and to get reimbursed with cash so that they can now fund new transactions. This drastic decrease in value prompted margin calls from many servicers who finance their acquisition for servicing. Now, what this means in layman's terms is that a decreased value of a lender's servicing portfolio reduces the lender's overall net worth. Now, since the amount a lender can lend is based on a multiple of their net worth, so the Fed's desire to bring mortgage rates down isn't just damaging servicing portfolios because of prepayments, it's also creating havoc in lenders' ability to hedge their risk. In an effort to reduce market rates, the Fed has been purchasing an incredible amount of mortgage-backed securities, causing their price to rise dramatically and swiftly. The recent amount that these lenders are paying in margin calls are staggering. They run in the tens of millions of dollars. All of this on top of the aforementioned stress that lenders are having to endure. So while the Fed believes that they are stimulating lending, their actions are actually resulting in the exact opposite. The market of government loans, jumbo loans, and loans that don't fit any ideal parameters have all but dried up. And many lenders have no choice but to slow their intake of transactions by throttling mortgage rates higher and by reducing the term that they are willing to guarantee a lock. I've said a lot in today's video, but I want to recap and leave you basically the overall synopsis of what I've said to help you understand what we're dealing with in the mortgage industry. Number one, we need the Feds to slow down the purchase of the MBSs so that a mortgage company can clear out their pipeline. Number two, we need lawmakers to allow for first payment defaults due to the forbearance to still be sellable. And finally, we need more clear, concise communication between the Feds and the regular consumer, that the Fed mortgage rates and the Fed fund rates are not the same. I hope this video helps. If you have any additional questions or if I can add value in any way, please do not hesitate to contact me. My contact information is listed at the bottom of this video. And thank you, and I hope this clears up some confusion.